You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good to be with you, Jim. We're doing a little early this week as I'm preparing to leave on what we call the Spring Thaw Tour. It's for older sports cars, and it'll leave from east of Vancouver here up into the mountains on Friday morning, and it'll ends at Sunday afternoon up at Whistler Mountain at the resort there, so it'll be quite interesting.
Quite a test of those old motors.
Yeah, and old arms.
Bob, what's happening with the bond market?
Well, you know that the decline in long-dated interest rates for the last couple of years has been without precedent. You have just never, the yield on the 10-year note in Germany got down to 0.056%. I mean, it's almost zero. And this is due to arbitrary decisions by the senior central bankers. They seem to know a lot about theories and very little about credit market forces. They have this idea that, actually it's a double wrong idea. Back in 2007, at the height of the bubble, one of the mainstream economists said that nothing could go wrong because the Fed had a dream team of economists. That was December 2007, right at the top of the economy, and 2 months after the peak in the stock market. So then you went into the crash 2008, the worst financial collapse since the early 1930s. So then they panicked and do the usual thing they do and started flooding the money supply. But the crash happened anyways. They started actually in June of flooding the money supply because that's when the first sign of troubles happened with Bear Stearns. So anyways, then of course all of these crashes, they end on their own when the margin clerks have sold out the last offside account. But these central bankers think that it won't end until they do something. So here you go. End of 2007, nothing could go wrong because the central bank team was there. Then in the crash of 2008, once it ended in 2009, they said it would have gone on forever unless we stepped in and were buying bonds and lowering interest rates. I mean, this is all virtually criminal bragging, you know. So anyways, they don't know when to stop. So they've been buying bonds, and the U.S. carried the bag for a while, and then the European Central Bank picked up when the Fed stopped, and they've continued buying bonds. And you have these absolutely absurd interest rates. Secular lows in interest rates in the senior economy, which used to be England, when it was on a gold standard, so you're protected, we're about 2.5% or 3% for the long bond, and now the 10-year note in Germany is down to next to nothing. So, but at any rate, we had on the U.S. bond market in February, the end of January, rallied up, and we were talking about a ending action in the long U.S. bond, and it came up and it gave upside exhaustions, all kinds of signals, and we had the high there, and then it corrected down to whatever moving average, bounced back up, and then as of the last couple of days, particularly today, the bond future in the U.S. sold off. Okay, fine, we're watching it. But also I was looking at what was going on with of course we're watching it every day, what was going on in Europe. And the Greek bond, of course, with their troubles, has been going on to register new high yield, up towards 13% almost. And so then in looking earlier today at the German 10-year note, yesterday it turned up in yield a little. So that's like from 0.065 to 0.09. It dropped down a little bit earlier today, and then boom, up to 0.16. Well, damn near a double in yield, although the numbers are absurdly low. The move is distinctive, and also as it came with a sell-off in the U.S. long bond. So, and then by the end of the trading day, the Greek yield was down. So it looks like at least in Europe, the whole world might have been shorting Greek bonds and been long the German note, and they're starting to unwind some of those trades. But anyways, it's interesting when something hits Europe and it hits the U.S. at the same time. So we think the long bond price is heading down. I think it'll be a significant trade. Our advice has been, when that bond was peaking for Treasury people who got to stay in the Treasury market, would be to shorten term and get defensive, and those that can buy, corporates could buy 3 to 4 year, prime corporates. Then you won't get hit too hard. So now this we would call a little warning in the credit market. And the other half of the credit markets are credit spreads, and they turned on a seasonal turn last June to widening. And then when, after September, when crude started heading down, there was I think 8% of all the new issues done of junk bonds were petroleum related, so of course they got crashed. And that exhausted itself in January, and then released. So at that point in January, crude was oversold, but also the junk bond was very oversold. So you've had relief in both, and then from March through to May, you can have that seasonal where junk bonds can perform well, and credit spreads relative low grade to high grade can narrow, and this is what's been happening. But somewhere in the next 5 or 6 weeks, you get through into May, and that's the time when credit spreads can reverse to widening, and I think that'll happen. There's just been so many excesses in the bond market.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. What's the outlook for crude oil right now?
Well, that one, as we mentioned, got very oversold in January. That one tied into some historical stuff. Often in a bad market in crude, it can run 6 to 7 months. January was the 7th month. So, and then we thought some relief, but it might take a number of months, 2 or 3 months, for it to form a bottom. And then, so here we are. It's firmed up because I think, February, we thought we'd get a rotation like last year where some beat-up commodities could rally out until the spring. So you've had the rally in crude, you've had a somewhat of a rally in base metals, and you had the start of a rally in the grains, but the grains got hit a few weeks ago with a weather system change where some areas got some rain that hadn't had any for a long time. So the grains have given up. Now, as of today, copper dropped down below, I know what it was. It gave a sell signal which was opposite to the buy signal of January. So we thought that there could be a rotation in the commodities where most of them would go up to around maybe April or May, and it looks like whatever they've done it, and that's as far as it's going to go. Lumber was the one that was absolute disaster. It's making new lows here. That thing fell out of a pattern in January. It was in a sideways wedge, so it was either going to go up or down. We thought it would go down, and it has gone down. This is not a good comment on the U.S. housing market or housing anywhere where they use wood. So the commodity side had a couple of months of sunshine, and now I think the clouds are coming in. And would we call them clouds of sobriety? I don't know. And then this gets us out to the gold markets, and gold has a problem because a lot of the people that follow gold are on the inflation kick, and we're not getting inflation in commodities. We've had inflation in financial assets, and that's just the way it goes. You can't get the old-fashioned type of inflation that ran through the 70s, where you had soaring wages and soaring house prices and soaring commodities, and most consumer price items were soaring. Now, consumer price items are going up, but you've got a bear market for basic commodities since 2011. But now we had a question here. So here our friend Bert in the Netherlands writes, Bob always explains that at the end of things, the market is in charge of interest rates and not central bankers. We see bubbles in a lot of markets and negative yields, even in sovereign bonds of some South European states. I see central bankers able and willing to support most every market as never before, from Japan to Europe. How long can this go on, and what will be the tipping point? Well, Bert's question is very timely, and as we opened up the show, there seemed to be an interesting change in the long bonds in Europe and England and Canada and the U.S. today. Too early to say if the trend is changing, but it sort of looked like a serious whack. So, Bert, I think what we should say on this one is that while central bankers have been able to push interest rates down hugely, particularly at the long end, they've had a willing public that can speculate in it. So the two central bankers and the public have driven rates down. But there's always the public and the trading side that pushes it too far, and we've seen the excesses reached at the end of January with the long bond in the U.S. and now perhaps in Europe. But with these German bonds, you know, we've tried all of our technical stuff on it that in a normal cycle would work, but these things just keep giving signals that we more or less stop looking at, because you're not dealing with a natural market. You're dealing with policymakers that have become fanatics, and there's no way out for them except that the market will look after it. So I think if you look at the yield curve, which is the difference between long bonds and short dated, and credit spreads, and you just used the Fed for the last 100 years, they intended to change that and prevent the business cycle from happening. And of course you've had 19 cycles and recessions and whatnot since. And the thing that is, I think, wrap it up by saying, while they can push rates for a while, they cannot, when it's ready to change, they can't handle the change in the yield curve or the change in credit spreads. So we're watching for the next change in credit spreads. Could be completed in the next few weeks, 4 or 5 weeks. And we've had a hit to the bond market. We're going to watch that to see what happens next. And then we'll finish off with the precious metal sector. And we say that it's difficult even for some traders to trade gold in U.S. dollars. You're trading a currency. But for investors, you want to hold a little gold somewhere in a safety deposit box. And for investors as well, there's the gold share side. So since November, we've been advising to collect a few gold shares on weakness. There's been a couple of days periods of weakness in there, December and then in the middle of March. But we wouldn't get ambitious in here, not fully invested. We're just going to wait for yet another buying opportunity in the precious metal sector.
Bob, thanks a lot, and best of luck as you tool your vintage sports car through the mountains.
Well, it's a 1967 Alfa Romeo sports sedan, and when they were new and being sold, the company advertised that it was the family sedan that wins races, and it's outstanding handling, great brakes, and a fairly quick car for that vintage. And what I like about it is you get in it, you sit upright, and you can see all the way around. And rather than the sports coupe or the sports car I've had before, when the roof was up in the convertible, it was hard to see out. So I think we'll have a good time, and thanks for changing the date.
Bob, best of luck.
Thanks a lot.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Check out our popular YouTube channel, Talk Digital Network. Find us on Twitter at TalkDigitalNet. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.